Nigeria's banking sector is set to enter a more stable and predictable phase in 2026, according to the full year 2026 banking outlook, entering a stable cycle report issued by Vertiva Research. That report notes that easing inflation, declining interest rates, and improved foreign exchange stability are expected to support stronger earnings, lower funding costs, and healthier loan growth as banks move away from FX-driven volatility toward a more sustainable core income performance. Oluwayemisi Sunmola, a banking analyst from Vertiva Capital Management, joins me now to discuss this latest report a little bit further. Good morning. Great to have you.
Thank
First
you
time
very much.
in the new year. Thank you so much. Okay, let's hit the ground running. Nigerian banks transition from FX-driven earnings to core operating performance. Why is this shift? Why is this important?
So we are seeing the banks move from the FX-related volatility as well as the higher MPR rates we saw within the 2023 and 2024 season. So we saw 2025 was kind of like a stabilization period for the banks, right, where we saw a lot of them actually record moderation in their FX income, given the relative stability we saw in the Naira. Also, we saw the banks generally record stronger core income, that those are their names. So we expect that, given the moderation we saw in FX, we would see that 2026 would be more of a build-up from the gains we saw in 2025. Hence, we will see a more reflective FX generation as well as stronger names.
Is this a major shift, as it were? Interest income is projected to remain strong this year. What factors will drive this growth compared to 2025? And do you think there are risks that anyone should look out for?
So in terms of our general expectations for interest rates in 2026, we see them coming down. However, we forecast that the banks will still remain resilient and would move from, because what we saw in 2025, the banks majorly recorded a lot of their gains from asset repricing, given the recent gains we saw in the MPR, right? So we are saying that for 2026, they will move more into a loan expansion, given the fact that they even have stronger capital buffers in order, and they can absorb shocks more. We see that this would be a major determinant of the growth in their core earnings.
Interesting. What easing inflation, moderating, as it were, not at the single digit yet, but at least we're not where we were 2-3 years ago, and now we're looking at gradual monetary policy cost expectations somehow. When the central bank, the first meeting next month. So how do you expect the cost of funds and net interest margins to evolve around that for full year?
So relatively, we expect that cost of funds will trend lower as a result of the general asset repricing, given the fact that we expect interest rates to fall. So for especially a lot of the banks, like the likes of GTCO and Zenith Bank, which have a lot of low-cost deposits, those are deposits in current and savings account, rather than those on term deposits, which are generally more expensive. They have more lower-cost deposits, so we expect that cost of funds will trend lower. And given the expansion in their loans, we expect that will drive up their interest income. Hence, we expect margin stability or a slight margin expansion in the year 2026.
So do you think that with the recapitalization ending in March, the central bank will begin to close the window on forbearance, as it were? So you talk about asset quality here. Is expected to stabilize this year? And which sector do you think poses the biggest risks going to the year, and how do you think banks will manage them post recapitalization?
So what we've generally been seeing is that the banks have actually been very moderate in terms of their loan growth, and they tend to allocate resources into sectors like manufacturing that tend to be stronger. So we expect that they would still maintain this in these sectors, and a lot of these sectors like manufacturing, oil and gas would be able to borrow more, given the fact that interest rates would be lower. In general, for the forbearance, as at last year, we saw the CBN come out to say before the bank can pay dividend, right, they are supposed to clear up their forbearance exposure. So we saw them clear out a lot of their forbearance exposure. So for 2026, we will see the banks actually have a cleaner asset base and record a more reflective and stable profit going forward.
So if we shift conversation a little bit around non-interest revenue, because there's so much FX volatility last year. So when you look at the revenue streams or lines that are best positioned to provide stable fee income this year, what would that be?
So generally, for the fee income, we see that digital expansion as a result of increased online transactions. So we are seeing even the CBN is coming out to say limit the amount of withdrawals individuals as well as corporates can do in a week, and we expect that those will feed into the amount of digital transactions as they can't withdraw as much, right? This will feed into their digital expansion and in turn expand their fee income. Already we are seeing FX levels, the amount of revaluation gains the banks recorded in 2025 already moderate, right? So we expect that 2026 will build off of the already revalued naira we recorded in 2025. So for 2026, we'll see a more reflective FX condition as we will see the banks able to actually record significant more derivatives and other FX transactions to bolster up the non-interest revenue line. So 2026 would be a good year. We expect it to be a good year for the banks.
Now, I'm sure folks in industrial manufacturing, real economy are looking at the banks recapitalization program and say, look, let's just wait until the end of March. Let's see how these banks will come up more stronger. And you alluded a bit to that in your earlier comment. What this will mean for what you call loan growth,
yes, as
far as the loan book are concerned, and what the competition will be for that in the sector in terms of more credit to the economy, yes, real economy this time around, yes, not just asset purchase, paper, government bonds.
Yes. So in terms of that, given the fact that the banks now have stronger capital buffers, like I alluded to before, right, we would expect that the banks would readily look to sweat these funds and generate returns on them. Hence, they would, once the recapitalization is done, we would see them churn in. So even in terms of that, we saw that most of the bank under our coverage has either met or exceeded their recapitalization. Even the likes of FCMB already have secured their national license, and we expect that they would move further to secure their foreign license. So in terms of that, the banks are actually very poised for a good long-term growth and would be a sector for investors to look into in terms of long-term positioning.
Let's talk about operating expenses. I'm sure still highly elevated despite easing inflation. What's the factor here? What's the cost pressure like? What do you think the bank should watch out for? Because you get higher capitalization and all of that is cost. Every naira comes at a cost. There's no free fund. There's no free money.
Yeah, so the line item of operating expenses actually looks at things like the AMCOM charges, staff costs, and other miscellaneous expenses. Those are what majorly covers the operating expenses. In terms of that, we expect that it will mirror kind of the trend we saw in 2025. With things like inflation and although we see inflation at moderate levels, so we don't expect that operating expenses would significantly affect profitability for most of the banks under our coverage.
So overall, would you say 2026, based on your report, is a recovery year or a consolidation year for Nigerian banks?
So for 2020,
or both?
It will be both. It will be more of a stable year with more. We might not see as high profit levels like we saw in 2024, given the revaluation and high MPR. But we'll see a more reflective, healthy profit levels for most of the banks under our coverage, barring any other economic externalities.
I'm sure you folks will go back to the drawing board after March 31st, to when the central bank finally reveals those who have crossed what level of recapitalization. And I'm sure again, you folks at Vertiva will come up with another set of robust report to give us a sense of horizon for the final 9 months of the year, going from the 1st of April.
Yes.
Thank you. Good to have you.
Thank you very much for having me.
Thank you, Sunmola, banking analyst at Vertiva Capital. It's always good to have you.